The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today is not my Chanticleer colleague Anthony McDonald, who's away on a well-earned break, but the AFR's Master of Markets. It's Jonathan Shapiro. How are you, John?
I'm very well, James. It's great to be making my debut this morning.
Great to have you. Well, this week we ask why gold has become the world's hottest investment. We try to solve the mystery that's had the entire ASX talking, and with voting now open in the federal election, we give our verdict on the Treasurer's debate. Well, Johnny, as I said, you're our Master of Markets. You're a former trader yourself. You're a Walkley Award winner. You're connected in the worlds of hedge funds and you know all the big name investors. So I've got to start by asking you about this big controversy on global markets this week. And that was Donald Trump's apparent threat to sack Jerome Powell, who's the chairman of the Federal Reserve. I guess you might say he's the US version of our Reserve Bank Governor, Michelle Bullock. Now, Johnny, markets really didn't like Trump's trash talk towards Powell. He called him a quote-unquote major loser. But the Donald throws stones at everyone. Why did these insults really matter to the market?
Yes, the market really did not like that. And this time I think he crossed a bit of a red line for the markets. And that's because Jerome Powell, the Federal Reserve Chairman, he sets interest rates. And, it's very sacrosanct that central banks around the world have independence. So that means they can set interest rates appropriately, regardless of whether the political, forces or wills are with them or against them. So obviously, when central banks are raising rates, they're very unpopular, but it needs to be done. And when they're cutting rates, the politicians love them because they're goosing the economy and it's all wonderful. The problem with Donald Trump is that he was getting really irritated that Jerome Powell wasn't cutting interest rates. So he's seen central banks around the world cut interest rates and give their economies a lift, but Powell was a little circumspect. He was worried about tariffs and whether that might be inflationary. So he was just sort of adopting a wait-and-see approach, and that drove Trump a bit crazy. And he threatened he said the end of his term couldn't come soon enough. Then there were whispers over the weekend that they were looking at ways to fire him. And then he obviously said those pretty inflammatory comments that he's a major loser and he's Mr. Too Late. I think the markets definitely do want interest rates to be lower.
Yes,
of course they do. They always do. They're holding out for rate cuts. But the rate cuts have to be done when the man in charge feels it's appropriate, and that's Jerome Powell.
So as you say, Johnny, he's backtracked a bit now. He said, I'm actually not going to sack him, but I might give him a call and tell him to lower interest rates. I mean, this is a bit of a mess. The irony here is that Powell's contract, his term, ends in 12 months. So do we think he's safe until then now?
Oh, it seems like the writing's on the wall for him. I mean, there's a lot of talk about what might happen before. I think there's talk that one plan to sort of neuter Powell at the moment is to put a shadow governor in that's going to start saying where he thinks rates would go.
Yeah.
And that would and everyone would Trump and the Trump administration would guide everyone to look at the shadow governor or the shadow chairman for guidance to sort of reduce Powell's power. But there's still a committee. The Federal Reserve's got a lot of checks and balances to make sure that it's independent. No matter who was put in place, would still have to answer to a committee. And so I think without extreme intervention, we should be pretty confident that US monetary policy will work. And I think the markets are a lot more relaxed now than they were when Trump was making those comments.
Yeah, well, as always with Trump, just wait a few minutes. I'm sure it'll change.
Totally. Absolutely. Now, James, it was a big week, obviously. We had Powell and Trump at each other. We had the death of the Pope as well, which made headlines around the world. But we also have the federal election coming up, and we had the two treasurers jousting it out in Melbourne this week. Now, you went along so that people like myself didn't have to.
Yes.
But I think it's very important, and I'd love to get your view on how it went and what we could take away from it.
Yeah, so this was Treasurer Jim Chalmers versus the Shadow Treasurer Angus Taylor. Look, it was a pretty messy debate. Lots of sort of name calling and accusations of lying and lots of sort of snide comments. I think this is two guys who are pretty tired of being out on the campaign trail, maybe tired of each other. But what it meant is we really didn't get too far beyond their talking points. The format was interesting. It was hosted by both the Business Council of Australia, which is the lobby group for the top end of town, and the COSBOA, which is the small business lobby group, and they had representatives from big business and small business firing questions. Look, I can't say there was any blinding revelations, except for there's no great leap forward in productivity coming from either of these guys. They acknowledge productivity is the problem. They want to get at red tape. But there's no great plans for doing that at the moment. There's some minor tax cuts. The coalition's got their cut to fuel excise, but there's no micro or macroeconomic reform coming in the next 12 months that I think is going to make a big difference to productivity. So I ended the debate feeling a bit flat about that. And I think most of the people in the room did as well.
Would you say there's major points of difference after you came away?
Oh, look, not overly. I think they're both. The major point of difference at the moment is probably around tax. Labor's got this plan for a very small tax cut to come through in 18 months' time. I think it's 70 cents a day, which Angus Taylor liked to repeat. And then the coalition's got their fuel excise plan. But no one's really attacking things like bracket creep. No one's really got any big picture productivity initiatives. And it's all got lost at this stage in some pretty petty name calling. So, look, if I had to pick a winner, I think it's probably Jim Chalmers. He's got a very good knack of coming into a room full of business people and saying, I know you don't necessarily like all my policies, but I'm still sticking with them. And he's quite polished at doing that. So he probably gets the victory on points, but it was a pretty low-key victory, I would have thought. I don't think too many people would have changed their vote based on what's happening in that room.
Well, like I said, glad you went along, right, so that we didn't have to.
Thanks, Johnny. All right, let's get to our first topic of the week. And while it's been a tough year for investors generally, it's been okay if you've owned the oldest asset in the book, gold. The price of gold has surged 26% since the start of the year to $3,300 an ounce. And as that Trump drama raged on Tuesday versus Jerome Powell, it actually touched $3,500 an ounce US for the first time in history. Now, John, gold is a mysterious and misunderstood asset, but it's great to have you here because I am reliably informed that gold runs in your family. Your dad is quite the famous trader in South Africa, and he's traded gold all his life. And I'm told, Johnny, that your grandfather used to get around Johannesburg wearing a badge that said "Buy gold." Is that true?
Yes, that is true. And I know of this because I run into people in Sydney that sort of tell me that they used to run into my granddad Archie on the floor of the Johannesburg Stock Exchange.
There you go.
He sounded like quite a legend. I wish I'd got to spend more of my finance years with him on the floor. But he loved gold. He loved gold stocks, which made up a lot of the Johannesburg Stock Exchange. My dad liked gold less as much. He was more of a Warren Buffett value investor, right? and I guess so. My view of gold sort of is sort of informed from my dad sprouting Warren Buffettisms at me, which is that Warren Buffett used to say, well, would you rather own gold bars or all the farmland in America and all the energy companies that exist in the US? And Buffett's answer was, I'll take the farmland. They're productive assets. Yeah. But one thing you could say about gold is that it has a track record over hundreds of years as a store of value. So while monetary systems and other stores of value have come and gone, gold has endured. So in a crisis...
And we should say, Johnny, that's completely sort of made up. There's no reason that gold is we've all just agreed that gold's going to be the thing that's valuable because it's shiny and it's pretty.
He's just got a longer track record than everything else.
Yeah, we could have chosen acorns or some other form of minerals, but we've chosen gold, and that's sort of become entrenched.
It's a bit of a religion, a bit of a religious belief.
Yeah,
why you trust in gold, but. I guess the appeal of gold is that we're on a cusp back towards, a loss of faith in the monetary systems we have, and but I think this time is a little there's a little twist to it, I think. And you could probably trace it back to, central banks got quite worried after the Russia-Ukraine war that, that their US Treasury bonds maybe aren't as safe as they thought. They could be seized. So they gradually tried to diversify and buy more, more out of bonds and into gold. And you saw the Chinese central bank accumulate, gold relative to treasuries. And I think that's sort of the basis for it. There's other theories as well.
Johnny, just to stop you there, it's worth sort of thinking about how that central bank, I think this is a really important thread at the moment. So what happened in Russia and Ukraine went to war 2022. As the war sort of developed across 2023, the Europeans came up with this idea. The Russians have got lots of currency, treasury bonds, investments around the world in other places. We're just going to take them. Yep. And so they just seized all those assets, froze all those assets and confiscated them. Now, while nobody is a great supporter of Putin or on Team Putin, lots of central banks around the world went, hang on, what if that happens to us? What if some other foreign power suddenly decides to freeze our assets? The one thing they can't freeze is gold. So let's have some more of it. So we've seen this huge central bank buying of gold, haven't we?
Yes, absolutely. It has, and over the months and years, people have followed and tracked, or since then they've tracked the accumulation of gold by China and other central banks, and this has been I think the tailwind for the gold price, and it's also been a bit unusual because up until recently, gold usually goes up when the US dollar goes down because it's cheaper to buy gold, which is denominated in US dollars. But, last year was a bit unusual when gold had a very, very strong run, even though the US dollar did as well. So that had a lot of, macro people and investors and gold bugs just sort of scratching their heads trying to understand what other force was driving the gold price. But I think this year, or at least the last few weeks, it's been more of a conventional, run to gold as people worried about the US and inflation and the what Trump might do to the central bank. Would propel. So gold had a very good week in the early part of the week as there were fears that he might override the Fed and cut interest rates.
Yes. So you've got that much more conventional safe haven story going on now. That the tariffs increase prices, leads to higher inflation, and then you get this shift back to gold because people are saying, well, the value of gold, that's going to stay rock solid. I can trust that as I've trusted it for thousands of years. Just to throw in a couple of other little theories for you, Johnny, that have been going on. There's now gold ETFs. So these are exchange traded funds that track the price of gold without you needing to buy any gold. So lots of investors have piled into them. But the ETF itself needs to buy gold as the gold price rises. So that sort of creates this cycle of demand and that adds to the upwards pressure on the gold price. The other thing that's been happening is interesting in China, where savings rates in China, so the rate of interest rates that are being offered to Chinese savers, they've been plummeting. So Chinese savers are going, okay, well, I don't like the interest rate the bank's offering me, which is 2/10 of stuff all. Where can I go? I'm going into gold. And so you've seen this buying from Chinese investors as well. So there's like this perfect storm of stuff that's going on that's pushing the gold price higher. But Johnny, just to get back to your to your grandfather's trading, so the gold price is flying. Does that mean gold miners are flying too?
Well, this is interesting. Gold miners are actually flying even more at the moment. So, through last year, the gold price went really well and the gold miners lagged. They didn't rise as much. And I think if we had to make sense of that, it's probably that, the share market was a bit questioning the sustainability of this gold price. So they didn't want to, forecast, such a high sort of run of earnings for these gold miners. So maybe they were a little bit discounting the future profits of gold miners. But this year we've seen gold miners, I think, are up on the ASX. The gold mining ETF is up about 50%, which I think is twice the rate of the gold price.
Yeah.
So you've done better this year owning the gold miners. And just to bring it back to the whole gold buffered this buffered tension about whether there is value in gold. Over the years, a lot of value investors have gravitated toward gold stocks. So they might hate the idea of gold. It's just a sort of shiny, glittery thing that has
pet rock.
Yeah, pet rock that has no productive value. But then they've looked at gold miners and go, wow, these miners are highly profitable, cash generative businesses, and maybe they're undervalued. But if you, I talked to some of the people in the ETF world, and they say that the flows into the gold mining ETFs haven't actually been that dramatic. So there's a huge debate whether gold and gold miners is a crowded trade or not, and you'll find people beating the table on both sides of that. What I'm interested, James, is if you think gold is going to keep going up.
Well, this is the $3,600 question. Look, I mean, actually, analysts are pretty positive about it. So what we've seen is, Goldman Sachs, for example, I saw a note this morning on Friday morning that suggested that the gold price is heading to $4,000. Now they reckon it's going to take about another 12 months to get there. But what's interesting is when you get these bouts of sort of Trump world instability, when Trump's raging and it's all markets are confused, that's when you see the gold price really jump up. So it appears that most of the experts are saying that the tailwinds are still there. So you've got this impulse from central banks. They'll keep buying because they're getting more and more concerned about a far more transactional US government that could do anything. Yep. You've got the ETF pressure, and then you've got the normal safe haven pressure that gold brings. So while you've got worries about inflation, while you've got, tariffs of 145% from the US to China, you're going to see a move back into gold. So for a moment, the momentum looks good. I think I'm a bit like you, though, Johnny. When you see something run so hard and everybody seems to be saying, hey, this is the sure thing, I think we both get naturally skeptical that there's a top not too far away. The one thing I'd say, I mean, you're talking about some of the gold stocks, just to name a couple on the ASX. Evolution Mining, up 65% year to date. Newmont is the world's biggest gold miner. It's got an ASX listing. It's up 45%. I guess the one thing you might say is the gold stocks might have further to run because they're still in a bit of catch-up mode to the gold price. So that could be interesting. But yeah, look, the experts are saying gold keeps running, but Johnny, I'm just a little bit skeptical about the crowd moving one way.
Yeah, and I can totally understand that. Gold has had a hell of a run. I guess if there was a case to own more, it might be that, gold's been a pretty effective hedge. Now, what the future holds, I don't know, but what we have seen is when everything goes down, gold has tended to go up.
Okay, Johnny, so let's move to our second topic. And while gold's been surging, so too has the most loved stock on the ASX. That's, of course, Commonwealth Bank. Now, the ASX 200, it's down about 3% so far this year, but CBA has risen more than 7%. But this week, something very mysterious happened when the stock leapt 4.2% for no apparent reason on Tuesday. Now, it was a seriously big move for a seriously big stock. It's one of the biggest moves we've seen in the past 5 years outside the GFC, and it actually helped the Australian market hold up pretty well as Wall Street was panicking about Trump sacking Powell or threatening to sack Powell. Now, Johnny, what made this remarkable was the fact that Commonwealth Bank is one of the most expensive banks in the history of the world. Now, we often say things like that, but let's explain what it means. So, what do we mean when we say Commonwealth Bank's one of the most expensive banks in the world?
Yeah. The valuation of Commonwealth Bank is higher than anyone else. And the valuation is the share price as a multiple of its profit is way higher than any bank in the world. So right now, Commonwealth Bank shares are around $160, $170.
Yep.
It's expected to make about just over $6 of profit next year. So it's over 25 times, the share price is 25 times its profit. So that means it will take you 25 years to get your initial investment back in the form of profits. Now, just as a comparison, Google, which is a pretty profitable, high-value company that's, doing very well, and it did very well overnight. It had very good results. Their share price is the Google share price is about $150. and it's expected to make $10 profit next year, $11 the year after. So that's only 15 years. You only got to wait 15 years compared to 25 years to get your money back. So
Right.
it just shows you how much investors are valuing the Commonwealth Bank. And the other sort of interesting thing to add is Commonwealth Bank is not really growing its profits that much. Right. I mean, sure, it's a terrific bank and it's hell of a safe, but it can't really grow. Australia's population might be growing, but not enough to sort of support a material increase in its profits, whereas Google's profits, I think, are expected to grow about 10% next year. So in all likelihood, that 15 years will probably be shorter because those profits will go up over time. So the high valuation of the Commonwealth Bank has been a real head scratcher. But the move on Tuesday sort of reignited this debate about what really is driving the Commonwealth share price to these extraordinary highs. So, no, James, I know you did a bit of, we both did our detective work over the weekend, but you spoke to quite a few brokers, analysts, investors, you even rang the Commonwealth Bank themselves for their take on it. So let's try and solve this mystery. What was going on?
Well, I guess there's three theories, and I might start with what you might call the mystery buyer theory.
Okay.
And that's this idea that there are a number of potential mystery buyers wading into the market, snapping up Commonwealth Bank shares for whatever reason, and not worrying about that very expensive valuation. So the suspects are a big US fund. We've seen some US funds come in and play around in the banks in the last few months. Maybe there was a big US investor coming in and buying up CBA shares and seeing CBA as a sort of safe haven. A lot of people are selling out of US markets. They need to reallocate that capital, come down to Australia, relatively unaffected by tariffs. And what do? You buy the most liquid stock, the stock you can get in and out of really easily. You buy CBA. Now, the other theory is that there's Asian buyers who are still underweight CBA, looking for a place that's not connected to, looking for stocks that aren't connected to China. Again, they're looking for big liquid places to hide. That leads them to CBA. And Johnny, there are some theories that some Australian fund managers, some active managers, are still underweight CBA and might be buying as well.
Yes. Now, this is an interesting theory, and it's a debate that's sort of swelled in the market over the last, I guess, at least the last 12 months, and that's that the superannuation funds for performance reasons, they need to stay close to the index.
Yep.
And over the years, they've hired a whole lot of active fund managers, and these active fund managers have looked at the share price of CBA and gone, that's ridiculous. We'll never pay 25 times next year's profits to own a bank. That's not growing. Yep. I'm paid to pick stocks based on my research and analysis, and unfortunately, I'm not able to convince myself that I need to buy CBA.
Yep.
So they don't own any CBA. Then what happens is CBA share price goes up. Their relative performance is weak. CBA share price keeps going up. Their performance gets weaker to the point where the super fund says, "I'm sorry, Mr. Fund Manager, you're fired because you're falling behind the index." They take the money away from that fund manager and they reallocate it to the index. And what that means is they need to make up for all the non-CBA shares, the lack of CBA shares that their fund manager had, and that creates a bid for CBA. And it's just created this self-perpetuating, migration of capital away from managers that think it's too expensive to super funds and other investors that need to make sure that they don't fall behind the benchmark and therefore have to scramble to own CBA. And I think what sort of accentuates that is that CBA has a very large and loyal retail shareholder base.
Yes.
So we know that retail are not buying. They are net sellers of CBA stock, but they're not selling in huge numbers. And most of them are quite happy to own CBA because they've owned it for a long time. And, the valuation argument doesn't really cut mustard with them because, they bought the shares much lower. So the dividends or the profits they're getting is very high relative to what they bought into. Yep. So they are reluctant sellers, if at all. And I think that maybe makes the register a little tighter and makes it a little, forces that incremental marginal buyer to have to pay a higher share price to get that retail investor or that other seller out of the market. Yeah.
So Johnny, I reckon that's sort of theory two, the super fund flows theory. Theory 3, I reckon, is what you might call the passive flows theory, which is where, there's a lot more money now in passive investments, which is like index investments or ETFs, where it's not about a decision to buy any individual share, but you're buying the whole market. CBA accounts for 11.5% of the ASX 200. So as more money flows into passive, that helps create this virtual cycle for companies like CBA. So that's the passive flow theory. I guess it's connected in a way to the super flow theory as well, right?
Yeah, and just like when the passive guys or the people that run passive funds, they get very offended by this argument because they say, and I think they have a fair point, we're saying it's not the passive flows, it's the active managers or the people that have decided that they need to follow the index rather than we like the passive funds. We're just doing we're just providing access to the index at the lowest price. We're not driving the buying. And often it's the fund manager down the road that's upset that he can't keep up with the index. that's the incremental buyer. But the point that the passive, the advocates for passive make is that why haven't we seen BHP and some of the miners perform at they're pretty big chunks of the index and they haven't run as hard. I mean the argument there is that those the miners are priced quite efficiently based on commodity prices around the world. The iron ore price is, there's very active buyers and sellers that calibrate the resource stocks a lot more than the Commonwealth Bank. But I think it's a passive is absolutely a factor. But I think as we've sort of discussed, there's a lot of theories and we can't be certain that any one of them is more dominant than another.
That's a really important point to make because when you do speak to the CBA itself, they sort of shrug and we're not quite sure what's driving this either. It's really, Johnny, a combination of all of the above, right? It's the rise of passive investing. Super funds and active managers are having to chase the benchmark to a certain extent, even though they think CBA is probably too expensive. They don't really have a choice. Unless you want to fall a long way behind the benchmark, you've got to buy more CBA, and that's created this sort of feedback loop that keeps pushing the price higher.
James, I've got a question for you on this one. Do you think this is a problem?
I'm not sure it's a problem. I think it's an anomaly. And I think it used to be the case that active managers would take advantage of anomalies like this. They'd sell or buy stocks where the valuation seemed out of whack. I think there's not necessarily a problem, but I think investors need to recognise that the power of those active managers is just not what it was. There's so much money that's flowed into passive investing. Momentum is a really important part of the market. I mean, we saw the league tables for fund managers come out this week. The top fundie was a guy called Steve Johnson from Forager. And what's his strategy been? To look for smaller companies that he thinks are going to get included into the stock indices, so that will encourage more buying of them by everybody. Everyone will sort of follow the leader.
Yeah, and you've written quite a lot about this, but I think the smart active managers are the ones that have realised the effect of passive and try to anticipate it. And it's whether it's buying or selling stocks that will go into the index, or using that as liquidity, or just understanding the flows. So I think active management isn't dead. It's sort of evolving, I guess, to account for this. All these new market forces that have become more dominant.
Very quickly on that, Johnny, I want to ask you a question. We saw Macquarie Group this week. They sold their public investments business, their active funds management business in North America and Europe to a Japanese company called Nomura for $2.8 billion. Macquarie's getting out of the game of actively managing stocks and bonds. Does that speak to this passive trend?
Yeah, it does, but it's probably more nuanced than that. I think what Macquarie's exit from public stocks and bonds shows is that it's very hard for fund managers to make money, which is it's very hard for them to manage portfolios of liquid assets like equities and bonds and charge a fee that justifies their value add in the process. Which again speaks to how hard it is to outperform these indices. So I think it speaks to a real fee crunch that's happened. As the value proposition of low-cost investing has been appreciated by more investors, big and small, and in some cases very, very big investors prefer to allocate at the lowest possible cost. And it's just made it very hard for fund managers to make money in these large liquid, and I would say it's just very commoditized. So it's just a highly commoditized part of the market. It's got there very quickly. I mean, Macquarie's getting out, but there's been a lot of damage done to ASX listed fund managers like Perpetual, Magellan, Platinum. I mean, some of their share prices are down 80-90% over 5 or 10 years. They were really like these great businesses that everyone wanted to own because they were highly profitable and could grow and scale. But now we're seeing the flip side of that. So everyone that predicted the demise of Active has been pretty much on the money.
Yes.
As a business. As a business, it's been very tough.
Big trend to watch. Okay, Johnny, we'll come back after the break. There's a really, really important bit of economic data coming out next week. We'll have a look at that. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Johnny, a couple of things to note coming up next week. Can you believe this? On Sunday, we have the 4th leaders' debate between Anthony Albanese and Peter Dutton. 4. Another one. My gosh. I'll maybe you can watch that one for us.
I'll leave that to Phil Curry and the Canberra guys.
I think I've had enough. On Wednesday, we get a really important bit of data in Australia. The quarterly inflation numbers are out. This is really going to confirm, I think, Johnny, whether the RBA is going to cut rates in May. What's your prediction? Do you think we're almost locked in for a May rate cut?
Well, the market is more than certain. So they've got a rate cut fully priced in, and they've got half of maybe even a 50 basis point prospect priced in. And I don't think anyone feasibly thinks that's likely. It's all predicated on crazy stuff happening in the US. But I think it seems like the RBA has got a handle on inflation, and it's in a position to cut rates.
And on Friday, I just wanted to note, there's a really important bit of data out of the US. I don't think we've ever mentioned the ISM manufacturing survey on the Chanticleer podcast, but what's happening in America is we're starting to see there's been a massive pull forward of demand before these tariffs. So consumers and businesses, manufacturers alike, have ordered a whole lot of stuff to try and get it onshore before the tariffs. In this data report on Friday, what we're going to see is if new orders, if demand is starting to fall off. If it is, that will be a signal that we are heading very rapidly towards a US recession, and that will be a shock for markets, which have actually rallied quite a fair bit. I mean, we're up 10% on Wall Street off the lows. We're not that far off. Stocks are back to where they were almost on Liberation Day, if you can believe that. So that feels wildly optimistic to me, wildly optimistic. But anyway, we'll see how that manufacturing data comes through. We're starting to see some signs of a US recession pretty close. All right, Johnny, we love questions here on the Chanticleer podcast. This week, our question's from Kieran Patrick. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email it to us. So Kieran asks, this is a very straightforward question. No sitting on the fence, Johnny. What's more important for Australia? Consistent growth in house prices or productivity? You have to pick one.
Right. Well, I'd be interested in your view, but obviously I'd go for the latter, the productivity. I think a few journalists and commentators, including yourself at the AFR, have made a fair point that maybe what we need is for house prices to stop growing. So that rules out number one, and we absolutely need to lift productivity. What's your choice, James?
Yeah, absolutely. We need to focus on productivity. House prices have had a great run, but be good for everybody, including any hope I have of getting my kids to move out of my house one day if house prices were stagnant for a while. They don't need to go down, but they just need to stay stable. And the reason productivity is important for the country, it's not about doing more with less or working harder. It's about growing the economic pie. If we don't grow the broader economic pie, it's going to be hard to lift living standards in the way that we've done over the last few decades. We need to get that back on track. Well, John, thank you for joining us. It's we're recording today on Anzac Day, and we should acknowledge, of course, the sacrifice and service of the servicemen and women, both today and in the past. It's always a very special day in Australia, so we pay tribute to the Anzacs as well. And John, thanks for coming on the podcast. It's been a great debut. Great to have someone in a big week for markets who can break it all down for us.
Thanks, James. It was a lot of fun. Hopefully, I'll be back one day in the future.
Absolutely. Absolutely. We'll see you all next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Jonathan Shapiro, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow, head of podcast is Lap Fan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.